Got no money on my mind, got no money on my mind, got no money on my mind.
Hey folks, welcome to the Jason Wright Show, Money Monday. Look, this is the episode dedicated to improving our finances, always in all ways. Part of our overall improvement has to be good stewards of our resources, and that's what Mondays are for on the Jason Wright Show. So with that in mind, let's go. Hey there, everyone. I just wrapped up my my regular show today, and I wanted to come onto YouTube, and I'm going to start trying to produce more actual content on the YouTube channel because I've really been miserable about that thus far. And today's episode was the first in a new installment that I'm going to be doing every Monday called Money Monday. Look, here's the deal. You know, the whole motto of the Jason Wright Show is to improve always and always. And this means everything from your nutrition, your physical health, your mental health, your relational health. And you can't really improve always and always and not touch on your finances at some time. You've got to be a good steward of your resources. You and I both do. And that's one of the things that I've done better at times in my life than others, that's for sure. And every Monday, I want to come on and discuss ways that we can all improve our finances always in all ways. And today, I talked about something that I think a lot of people get hung up on at a time that they really shouldn't. And that is index funds versus mutual funds, or rather the funds that are just following an index and that are basically managed by computers versus those that are actively managed by mutual fund managers and active traders. And here was the point that I made on the show today. If you are not investing anything, then that should be the first area you tackle. It shouldn't be a matter of which fund do I invest in. It just needs to be a matter of making the decision to start investing. And then here's another thing that I think you got to consider. You and I, if you're watching this, you're most likely not an active money trader. Okay. You're probably not someone who's even a stockbroker, a financial advisor. You're just someone who listens to the podcast and you probably learn about biohacking or whatever you get from the Jason Wright Show. And I know that for years, even though I was not a professional money manager, I let my ego get in the way thinking, you know what, I don't need a money manager. I don't need anyone telling me how to manage my money. I can do it. In fact, whenever I was probably in my early 20s, I opened my first SureTrade account, which doesn't even exist anymore. It was one of the very first online trading platforms. And I made a little bit of money, but it was during the .com era where, you know, even an idiot like me can make money. I mean, a monkey throwing darts at a dartboard could actually pick stocks as well as I could at that time. And so what I did was I managed my money when I shouldn't have been. But fortunately, during that time, one thing I also did was I had a couple of mutual funds that I set up. And I just it took the set it and forget it approach, right? I just put some money in, opened an account with $250, $500, I don't remember what it was, and just started having auto withdrawals from my bank account every single month go into those. Of all of the investments I have ever made in the stock market, the ones that have performed better than any other are those that I had the set it and forget it approach. So the point that I want to make today, make sure that you first start investing and then look, don't be overwhelmed by the process. Look, I know some of you, if you happen to stop upon this video and you've never invested at all, it can be kind of daunting. And you think that there's just some kind of these mental gymnastics you got to go through, and you got to know all this information about math. And again, do I invest in the index 500? Do I invest in an index 500, which basically follows the S&P 500? Do I invest in large cap, small cap, whatever? First thing you need to do is decide to invest. And one of the things that I also covered in the show today that I want to make sure that I get across during this video is this. If you are someone that's in your early 20s, then you are probably, no, it's not a probably, you are actually wealthier than I am. You really are. In the part where, you're wealthier in an area that matters most. Time. You have time. I'm 48. I do not have as much time to get my financial house in order as you do. And you need to leverage that. It's the greatest thing you have to leverage in the world. It's the one area of life where you're actually wealthier than Warren Buffett. Warren Buffett is worth somewhere around 114 billion, I think, at the time, or 104, 114 billion as of this recording. And yet, I guarantee you, if you were to meet Warren Buffett and you were to say, hey, Warren, I want all your billions. And he said, okay, I'll make you a deal. You can have my billions, but you also got to take my age. Would you take that trade? Would you decide to be 92 years old with $100+ billion? Or would you rather be yourself, be 22, 23 years old with a couple $100 in the bank? I mean, what good is billions of dollars going to do you if you're already against the clock? Warren Buffett is already, based on the actuarials of life expectancy, he's already living on borrowed time. So you are wealthier than you realize if you're starting out, even if you're 30, 35, 40. The point is you have time. So get started investing right now. I can tell you without fail, of all of the investments that I've made in the market, the ones that have performed the best, not necessarily because they were the best assets that were purchased, but the ones that have performed the best for me and looked the best in my portfolio are those that I had absolutely nothing to do with after I decided to sign up and invest in the account. That was the extent of my involvement. The rest was either an index fund that was managed by a computer or an actively managed mutual fund that I had nothing to do with. All I did was set it and forget it. $200 a month, $25 a month, $50 a month, it didn't matter. I didn't have to think about it. Therefore, I was not able to get in the way of the process. The other trading accounts that I've had in my life, I'm an abysmal, my track record, my trading record is abysmal. It's horrible overall. It is horrible. And here's the thing that's so beautiful is unless you are going to be trading stocks every single day and that is your profession and you're getting paid to do it, why not outsource it to someone who does that? They've decided, I want this to be my vocation. And it's kind of nice to hire people, especially when you don't have to pay them a salary. It's beautiful. And we can do that. We can do that with a CPA. We can do that with a realtor. We can do that with a financial advisor. There are so many professions out there that you can have as a team. And I suggest you do that. I suggest you, at a young age, put together a team of experts that you work around and you check in with them and get yourself in the mindset, these people work for me, even though they're not on salary. That's what they do. Outsource to the professionals what they do, and you do what you do with 100% focus. Don't get in the way of investing. So I just want to let you know that part of improving your finances always and always is taking advantage of time and the compounding effect of money. You've got to invest year over year over year over year, because you got to remember, if you just even start out with something as small as $25 in 30 years with like a roughly 7% growth rate compounded annually, then in 30 years, you're going to have around $38,000. No, excuse me, that's probably not right. It's probably close to $30,000. So imagine you just put in, and that's not even starting with $1,000 or $250, anything like that. That's just like, all I can scrape together is $25 to get my account open. And with an index fund, you'll probably find one that will let you open an account. Most of them, it's at least $100. I don't know if there's one out there that will allow you to open up with $25, but let's say it's $100, $100. If you had to save for 2 months to put together $100, one $100 bill, one Benji, and you open an account, and then you fill out your auto deduct from your account, your savings account, your checking account, whatever, and it's $25 a month thereafter. Then in 30 years, without doing anything other than, you don't have to think about it, you don't have to look at the market, it doesn't matter if the market's up, market's down, you've decided it doesn't matter, I'm not going to think about this account again for 30 years. Then you'd have like roughly 30 grand sitting there waiting for you. Is it enough to retire off of? No, it's not. But at least you did something. And then as you go through the course of your career and you start making more and more money, you bump it up. You bump it up. You go into your online account. You say, I want to increase my deductions to $50, $75, $100, $150. You scale up. The point is, though, don't get hung up on index versus actively managed. The bottom line is just invest and leverage your time. If you are young, leverage the greatest thing you have. Now, I want to say one more thing to the young people. I went on kind of a rant on the podcast this morning. for this very reason. It's kind of hitting home right now for me. The first business that I ever bought, it also came with the first significant piece of commercial real estate that I ever purchased. And it will be 20 years ago tomorrow, Independence Day, that I actually did that deal 20 years ago. I don't know where it went, but it just blew by. And that's the point. I remember back whenever I did that deal and I bought that asset, I remember thinking to myself, I've got to get this paid off really early or I'm going to get out of it and get into something else because I can't just wait to pay this off over a 20-year period. I'll be so old. I'll be 48 by then. And then life is basically over. I'm done at 48. Nothing can be further from the truth. I can tell you right now, young people, and by young, I mean under 40, your 30s, your 20s, it flies by so fast. And here's the cool thing. And I don't say this just because I'm denying that I'm getting older. I'm well aware of the fact that I'm getting older. I'm pushing 50. But here's the thing that you think whenever you're your age, when you're younger, you think that someone who's 48, 50, they're really old. They probably feel old. They look old. But I can tell you, my mind, I can still remember very vividly things I thought when I was 24, 25 years old. I can remember the things that I thought on a day-to-day basis on multiple days that when I first bought that building, that asset 20 years ago. As for how I feel, granted, I take care of myself. I'm the improve always and always guy, so I'm pretty healthy, right? But nevertheless, my mind, and I don't care how bad a shape, people's minds still, they don't feel their age at this age. They just don't. So I only say that to let you know that 20 years from where you are now, you're going to feel roughly the same. You're not going to feel as extremely older as you think you will right now. I'm living proof. I'm sitting here at 20 years after buying that building thinking, man, that went by really fast, really, really fast. And two, I feel great. I still feel as young as I did back then. So therefore, don't think that if you're starting something with a 30-year timeline that it's not even worth pursuing because it's just too far out in the future. No, that's the benefit. That's the benefit. You don't have to start big. You can start small because you've got this thing that no amount of money on earth can buy, and that is time. You've got that. Leverage it. So with that, set it and forget it. Unless you are an active trader, unless this is what you do for a living, I highly suggest you go find whether it's active or index fund, I really don't care. If you have the opportunity to invest in your 401k, I know 401ks are not as popular as they once were back whenever I started working. But if you've got one and you actually have an employer that will match part of your contribution and you don't take advantage of it, you're just dumb. You're being dumb. Okay, I don't want to say you're dumb, but you're being dumb. And here's why. Some of you actually work for companies that will match your 401k up to 5%. That's like a 5% raise just for being you. How many of you will get pissed off if you go into your performance review this year and you don't get some sort of, you get mad because you don't get a 3% cost of living increase? That would piss you off. We're not doing raises this year. You get mad, you get angry, you go tell all your friends, you go kick your dog, you walk home, you throw plates against the wall and shatter them. I didn't get a raise, I didn't get my 3%. You got 5% sitting there waiting for you to just go give to yourself. Go in there to your HR department and say, yeah, check. I'm going to now. You don't do it because you don't feel it right now, right? It takes it's first you have to invest, and then you got to give them something to match. But if they will match you dollar for dollar up to 5%, that's a raise you can give yourself right now. You don't even have to have a good performance review. You can suck. You can really not do well that year. Your performance could just be horrible. And still go give yourself a 5% raise. Free money. Take advantage of it. And one of the things that Dave Ramsey found, and he's done a ton of research on millionaires. He likes to look for correlations. That's what his show's all about, right? Is how to be financially free. Live like no one else, so one day you will live like no one else. I have a great deal of admiration for Dave Ramsey. I just came from his offices and studios. I was there. It has already been 2 weeks ago. Spent 3 days out there. Unbelievable, unflipping believable what Dave Ramsey and his team have built. Great team, just cool people, kind people, smart people, sharp people, beautiful facilities. I got to go to his brand spanking new conference center. Unbelievable. And one of the things that Dave Ramsey is constantly looking for is correlations in millionaires. How do these people, what commonalities exist universally amongst the greatest amount of millionaires out there. And one of the things he found is that most millionaires, most people that have made $1 million, first of all, most of them didn't inherit it. It's a very, very small percent. I think it's like less than 5% of people that are multimillionaires or even millionaires, they inherited their wealth. It's a very small portion. Most people actually had to go out and make the money. But here's what's really cool. A lot of you listening to this are just like I was at one time. You think, if I'm going to be a millionaire, I've got to do something that pays me $1 million, or enough good decisions time over time, enough good real estate deals, enough good stock market trades and investments, whatever, that I do that and make $1 million. I go become an attorney or a physician and I save my money and I get paid $1 million a year. I become a rock star. I become a world famous, world champion beatboxer. And that's how I get discovered on Yo MTV Raps, and then I will become a millionaire. Well, you don't have to do that. Most millionaires are pretty freaking boring how they got there. You know what they did? They did exactly what I'm telling you today. They started early. They started saving and saving and saving. And their first $1,000, whenever they put in $2,000, then $3,000, and then $4,000, it started growing and compounding exponentially. And one day they looked up after 25, 30 years of just doing their thing, not coming up with the next Windows, not winning the National Beatbox Championship, not winning a spelling bee. They actually just did their thing, set it and forget it, didn't think about it, and retired millionaires. Most millionaires are very boring. Most millionaires are plumbers, electricians, people that do very normal things. They just exercised discipline, and here's the cool thing. If you do what I'm telling you on the set it and forget it thing, and you start early and you start small, you just resolve yourself that you're going to do it in perpetuity without thinking about it, it doesn't require any discipline. What will require discipline? So, and this is the thing too. If you've got a choice to do something that can become automatic versus manual, the thing that's automatic is most likely going to be done over the long haul. The thing that's manual there's going to be challenge, because here's the thing. I don't care who you are. I don't care if you're listening to this and you go, Jason, you don't know me. I am the most disciplined son of a gun you've ever met in your life. Look, I don't need to do that set it and forget it thing. I will write out my check. I will whip out my big checkbook, open it up, and I will write my check, and I will stuff it in an envelope, and I will lick my envelope, slap that stamp on, and I will take it to the blue box and get it out there every month. I will say, I don't know what kind of crack you're smoking, but you need to put that pipe down right now, mister, because you're dumb and you're not going to do it. You're not going to do it. And here's the thing. Even if you are someone that would do that, let's say you would do that 20 months in a row. Here's what's going to happen. You're going to get a flat tire. You're going to decide that you need a new Alpine stereo system with a cassette deck, because Quiet Riot has just come out with their reunion tape and you want it. And it happens to cost the exact same amount of money, well, minus installation, to actually buy what you invest every month. So then you go to write your check and you go, oh man, Alpine, Quiet Riot. You may make the right decision, but you probably won't. It's a new cassette deck. It's Alpine. It's Quiet Riot. Here's the deal. Remove the need to even have this internal dialogue. Remove it. Remove all resistance. Remove all resistance by automating it. You don't. All right, let's get serious for a minute, because you're not buying a cassette deck from Alpine. That'd be really weird. Who right? My kids, I'm old enough that my girls have never even had a cassette tape. They've never owned one. They know what it is. I asked them one time, I said, y'all know what a cassette tape is? They said, yeah, I know. Have you ever had one? No, never. Whew, makes me feel old. But what is going to happen is this. You're going to have a flat tire or something, and you're going to want to use that monthly investment as an emergency fund. And all it takes, good habits are real easy to break. Bad ones are hard, good ones are easy. You're going to go to write that check and you're going to think, just had a flat tire, got to get this thing fixed. I'll double up next month. That's what you'll do. You'll tell yourself, look, I've got to get my car fixed. I'll double up. Next month comes and you think about doubling up and you're like, I got a little bit of money left. That extra $200, I'll triple next time. Here's what's going to happen. You're going to break the streak. Streaks, once they're going, they're money. Once they're broken, getting them started, pushing that boulder uphill, starting, it's so heavy. You got to get the momentum. And if you break that momentum, if you do it automatically, here's what's going to happen. If you do it automatically, that money will mentally become not even yours anymore. It's gone. It belongs to your future. That money belongs to your retirement. It belongs to future you. So it's gone. It's not even here in today you. It's not even there. So therefore, you know that $200 is going away automatically. You don't even think about it anymore. Just you look in your account and you don't have to think. It's not there. And so you start saving money in addition to the $200 that you're putting in automatically, so that you can fix the tire when you need to, without touching that and never having to start over. It's a flywheel. I mean, that's a cool thing about investing. When you start early, you just start the flywheel, you spin it like on what was it, The Price is Right that they did that, or the Wheel of Fortune. You just spin it. And then it just starts the flywheel effect. It just spins. And the thing is, you're not even having to use your finger because the computers do it. They're just automatically going in, taking the money and putting it in your investment. You don't have to think about it. You remove all resistance. This is behavioral science 101. If you want something to last, if you want to do something that is going to be good for you for the long haul and you don't want it to quit, you've got to create automaticity. It's got to be automatic. You can't think about it. If you have to think about it every time you do it, the likelihood of you doing it is not going to work. All right? So just get it started. Don't get hung up on manage versus index. Just get started. All right? And please come back. Please leave a like or subscribe and come back here every Monday for the next episode of The Jason Wright Show, Money Monday. And then please listen in on Tuesday, where I usually have a long-form interview with world-leading experts, authors, just really bright, smart people that I'm trying to learn from, that I'm trying to take their big brains and pick them to make mine improve always and always. And until we meet again, that's what I want you to do. I want you to continue in your own personal endeavor to improve always and always, because here's what I truly believe. If we can do that, and if we are able to present the absolute best version of ourselves to the rest of the world, the fruit of that will spill over, and we will just make a better world, a better global community, and that's what we're all about. All right, thank you so much for tuning in.